Well, good evening. So let us start the session. Today we will take up fire loss of profit. Fire loss of profit insurance. So try to understand the product now. I'll share it. Yes. This is fire loss of profit insurance. And about this insurance, there are two important conditions. First, there has to be a fire policy in place. Here the fire policy will be called as material damage policy. It has to be in existence. Means this policy can be given along with the fire insurance only. If there is no fire insurance policy, a FLOP policy cannot be given. Fire insurance policy you can give alone, but fire loss of profit policy you cannot give alone. Secondly, if claim is paid under fire policy, then only the claim will trigger under the FLOP policy. Means when the FLOP policy is given, there are fire plus FLOP policies. If there is any loss to the insured property, the claim is payable under the FLOP policy for that loss. Then only FLOP policy will pay the loss. If the claim is rejected by the fire insurer, in that case FLOP claim will also not be paid. Try to understand the equation. This is very important. Why? Because FLOP policy does not work standalone. FLOP policy cannot be given to any customer standalone. Unless there is a fire policy, FLOP cover cannot be given. This policy is known by three different names: business interruption insurance, consequential loss insurance, and loss of profit insurance. Loss of profit insurance word is used for two purposes. One is with fire insurance, that is called FLOP, fire loss of profit insurance. The second one is with machinery insurance, then it is called machinery loss of profit insurance. So, if you want to sell the fire loss of profit insurance policy, in our company there are four systems. If you are giving an IR policy to any of the customers, this fire loss of profit section is inbuilt in that policy, and that is automatically given. There is no choice. That is the compact policy. If you are giving a fire policy to any factory, SME, commercial institutions, fire policy means any fire policy like Sukshma Udyam, Laghu Udyam, or Standard Fire and Special Parent policy, not Bharat Bira Richa, only for commercial purposes. So if you are giving any of these three fire policies, then you can give with them a separate FLOP policy also. The only thing is you will need a separate proposal form for FLOP. In combination, fire plus FLOP can be given. The third option is BPP plus FLOP. In business protected policy, FLOP section is not there. So when you are giving a package policy like business protector policy, fire section is covered, and that is mandatory. You can give the FLOP also to any educational institution, medical, hotel and office. Medical means hospital, etc. And the fourth way is Shri Shopkeeper Insurance or any package policy. Means in addition to the business protector policy, FLOP section is there in our all other package policies. So if you are giving a hotel and restaurant policy or educational shield insurance, you don't need a separate proposal form because this section is already there. Customer only have to select. Even in Shri Shopkeeper Insurance, customer only have to select. So these are the four methods of selling business for business units, the FLOP cover. IAR, which is already having the FLOP section, like other package policies. If you are giving a separate fire insurance policy, you can take a separate proposal form for FLOP also. If you are giving a business protector policy, again you can take a separate proposal form because the fire loss of profit section is not there in the business protector policy. And fourth one is shopkeeper and other package policies. These are the four methods of selling. But when you are giving a shopkeeper insurance policy to any of your customers, shopkeeper insurance policy, it means you can give the fire loss of profit cover to shopkeepers also. But there are restrictions. In our policy, Shri Shopkeeper Insurance policy, if you are giving to any customer and the customer is also taking the fire loss of profit section, then these four conditions will apply. Sum insured will not exceed 25% of the fire sum insured. Suppose fire sum insured is 4 lakh, you can give FLOP cover for 1 lakh only. Second is indemnity period. The indemnity period is opted by the customer himself. That could be multiples of 3 months, 6 months, 9 months, 12 months, 15 months, 12, 3 months, 21 months, like that. But in Shri Shopkeeper Insurance policy, if the FLOP cover is given, the indemnity period will not exceed more than 3 months. Third, premium rate is fixed 360 rupees per lakh plus GST. And fourth, minimum premium is rupees 500 plus GST. These conditions are applicable only for the FLOP section given to shopkeepers under Shri Shopkeeper Insurance policy. If you are giving any other policy to any other commercial unit, like business protector, like hospital, hotel and restaurant, like medical, educational institutions, or only fire plus FLOP, or IAR plus only IAR, then all these four conditions will not apply. These are applicable in FLOP section for shopkeepers only. Now what is FLOP? Try to understand. The policy covers the financial loss of the risk due to interruption in business following loss of damage to insured property covered under the fire and special peril policy or Sukshma Udyam or Laghu Udyam. What does that mean? That means this policy will cover only loss of profit only financial losses, only loss of income, and nothing. Because there is a separate policy, that is fire policy, that will cover all material damages. And there is block-wise separate sum insured for building, for accessories, plant and machinery, stock, furniture, fixtures. So that is covered under the fire policy. Only the loss of profit is covered under the FLOP policy. So the purpose of FLOP policy is to protect the insured against loss of income or loss of profit. I repeat, the purpose of FLOP policy is to protect the insured against loss of income or loss of profit. If there is loss to the building or to the machinery or to the stock or to the furniture fixtures, FLOP will not pay any claim. These losses can be claimed under the fire policy which we have taken together with the FLOP policy. These losses are covered under the package policy wherein you have selected the fire insurance also and other sections and FLOP sections. So the losses will be paid under the fire section and the loss of profit will be paid under the FLOP section. So who can take it? Proposer must have fire policy. The person who has the fire policy can take FLOP policy also. But two or more conditions are there. Proposer's business must continue. If it is closed 6 months before or 1 year before, policy will not be given. FLOP cannot be given. Fire policy you can still give. If the shop or factory or industrial unit is closed, fire policy you can still give, but FLOP you cannot give. Secondly, proposer should be earning income or profit. If the unit is continuing, it is running, it is not closed, then only it will earn the income. Then only it will earn the profit. So if it is continuing, it is earning the income. To protect that income, you are taking the FLOP policy. And when you are taking the FLOP policy, simultaneously you are taking the fire policy also. Because if there is any loss to your business, to your building, to your machinery, that will be paid under fire policy. And loss of income will be paid under the FLOP policy. So there is a difference between fire policy and FLOP policy. Here both the policies will be given simultaneously. But there is a difference. Because fire policy will cover the material losses. Material means building, property, machinery, stock. And FLOP policy will cover only the profit or income. So loss of gross profit following operation of the insured peril or by increased cost of working is covered under the FLOP policy. All other losses are covered under the material damage policy, that is called fire insurance. How this chain will continue? How this sequence will continue? This is the flow of events. Try to understand it. First of all, there has to be a material damage policy, that is called fire policy. This can be under a package policy. If we are giving a package policy, there is again fire policy, part section is there, and that is mandatory. So there is a material damage lost to the building or property or to the machinery. And that loss is indemnifiable, means payable under the fire policy. That loss is payable under the policy. Say suppose flood loss is there. So due to flood the building has been damaged. Fire policy is there. Fire policy will pay the flood loss. That means this loss is indemnifiable. Fire policy is paying that loss. But due to that loss, there is interruption in production process. Flood has damaged the buildings, so the building of the office or the commercial unit or the factory or the industrial unit or any commercial unit is shut down or closed, maybe for some time. So there is interruption in production process or sale process or service process. And due to that interruption, there is a reduction in sales turnover. Means there is a no sale or no turnover or no manufacturing, no output. And due to that, there is a loss of gross profit. So the sequence will continue as it is. There is material damage. That damage is payable under the fire policy. Due to that damage, there is interruption in production process. Due to that interruption, there is a reduction in sales turnover. Due to that reduction, there is a loss of gross profit or income. Now, how the sum insured of this policy will be decided? So, we say we will cover the anticipated gross profit of the project. Means whatever gross profit the customer is expecting during that year, he can take it as a sum insured. Say for example, a factory owner of taking policy, FLB policy for 1 crore. His turnover in the previous financial year was only 90 lakh. This year he is expecting his turnover would be 1 crore. He is taking FLB policy for 1 crore. We will give it because that is anticipated gross profit. There is a difference between turnover and gross profit. The rather prepaid bird is that anticipated gross profit. Suppose previous year the anticipated or his actual gross profit was 90 lakh. This year he is expecting his gross profit as 1 crore. So he can take it. But he is expecting contrary to it, means there could be a loss this year and he wants for a lesser sum insured, maybe for 60 lakh or 70 lakh, that also he can take. There is no compulsion. This is as per the choice of the insured. Anticipated gross profit. Secondly, there are 3 different periods. 3 different periods which are important in FLB policy. First one is the simple one that is applicable to all the policies, that is policy period. Policy period is annual. This policy is normally issued for 1 year only. Annual period during which the company bears the risk, for example, policy start from 1st January 2024 to 31st December 2024. This is called policy period. Second period is important, that is indemnity period. Indemnity period represents the insured's estimation of the maximum period required for normal business operations to be restored following a loss. That should be mentioned in the months like 3 months, 6 months, 1 year, 1.5 years, 2 years. That means if there is a loss due to insured peril, after how much time insured would be in a position to restart the business? That period insured has to select himself, because he better knows how much time he required to restart his business. That is an indemnity period. And third one is interruption period. Interruption means the actual period of interruption, starting from the date of loss till the date normal operations has been restored. It can be more than the indemnity period, it can be less than the indemnity period. But insurer's liability is restricted to lower of the two. If the indemnity period is lower, insurance company will pay for that period. If the interruption period is lower, insurance company will pay for an interruption period. How it is, I will explain further. This is a sketch which will show the correct picture. Suppose you have given a fire plus FLOP policy to a customer. Now policy starts from January 1st to 31st December. This is policy period of both the policies. Now on March 1st, there is a cyclone. And due to that cyclone, there is a loss. And then business was interrupted till February 15. Thereafter it came to the full stream. March 1st to February 15th. This is interruption period. But the indemnity period selected by the customer is only 9 months. Only 9 months. So 9 months will complete from March 1 to January 1. But the business was stopped till February 15. That means indemnity period was longer. So insurance company will pay the claim for the indemnity period only because this is the lower. Interruption period or indemnity period, whichever is lower, the insurance company will pay the claim for the lowest of the two. Another example I will give you. This is interruption period. How it is shown? A firm is running, you have given the FLOP policy. It is a period which starts from the rate of loss and ends when the business achieves the same production level where it was prior to a loss at the insured premises. Means you have given a policy for 1 year. The customer selected indemnity period says for 6 months. On this date there is a loss. On this date, maybe it's the 1st April, there is a loss. 9 months indemnity period is selected, 6 months. So 1st April to 6 months is the indemnity period. But the business was fully restored after 9 months only. So interruption period is bigger, indemnity period is short, claim will be paid for the indemnity period only. What claim will be paid? That is to be seen. Because there is a net profit, net loss. Net profit is what? If you are deducting fixed cost and standing charges from the gross profit, the remainder is the net profit. Gross profit minus standing charges is equal to net profit. Or you can say, suppose fixed cost is more than gross profit. So fixed cost minus gross profit is net loss. This is a simple method. But in this calculation, you need many things. You have to include the standing charges. Standing charges means fixed expenses which continue to incur irrespective of the production level. Even if the factory is closed, these expenses will continue. Suppose the flood has damaged, these expenses will continue. Plant is shut down. Insurance premium the owner has to pay, rent of building has to pay, salary to the officers has to be paid, dividend has to be paid, interest on loan, administrative cost, vehicle rent. These expenses will continue. then which expenses will discontinue? These are called variable expenses. If the plant is shut down, these expenses will also be closed. These expenses vary with the production level, or the service level, or the sale level. No cost incurred when no production is there. For example, cost of raw material, freight inward, electricity, labor cost. When there is no output, there is no labor, no electricity, no cost of raw material. So they have to be accounted for. Rate of gross profit can be calculated, whatever that gross profit is there, what is its percentage over the turnover. Gross profit includes standing charges plus net profit plus increase in cost of working. Then it comes the gross profit. For the people from the accounting background, it is easy to understand. What is the gross profit? Gross profit is the amount by which the sales turnover exceeds the manufacturing cost. Suppose sale is 20 lakh rupees, sales turnover. Manufacturing cost, that is including of all expenditure, is said 12 lakh rupees. So remaining 8 lakh rupees are the gross profit. Now, how to decide the sum insured of the policy? Sum insured has to be selected by the customer. But on what basis? This will impact the indemnity period selected by him. If the indemnity period is within 1 year, that is up to 12 months, in that case, the premium will remain the same. But if the indemnity period is more than 1 year, that is 18 months or 24 months or 3 years, in that case the premium will be multiplied in that proportion. 18 months, 1.5 times, 24 months, double, 30 months, 2.5 times. Because the indemnity period selected is bigger one. And this depends upon the insurance to insurer how much indemnity period they provide to select to the customers. Now, what are the perils covered in the FLOP policy? The same perils which are insured under the fire policy. All perils covered under the material damage policy are also covered under the FLOP policy. Why? Because if the fire policy is paying the claim, then only the FLOP policy will pay the claim. If the fire policy have rejected the claim, FLOP will also reject the claim. This is a precondition that the claim must trigger under the material damage policy, that is fire policy. And if it is paid, then only the FLOP policy will pay. So fire policy covers all the 14 perils. If the sum insured is up to 5 crore or over 5 crore but 50 crore, all 14 perils will be applicable. If the sum insured of the fire policy is more than 50 crore, then only 12 perils are there. All these perils are fire perils as it is. There is no change. If we are giving a FLOP policy along with the standard fire and special peril policy, for 12 perils will be covered, plus add-on, whatever add-on has been selected. Because add-ons, you know, as per tariff, there are 15 add-on covers along with the standard fire and special peril policy. Now, how much add-on covers the customer has selected, that is important. If the customer has selected only 1 or 2, they will become part of the coverage. If the loss is due to them, that will be covered, that will be paid. Now, when you are giving a FLOP policy, so bare minimum information required from the customer to generate the quotes is this one. Whether there is a fire policy, detail of that, basis of accounting, which method is adopted, list of standing charges, indemnity period selected by the customer, gross profit of the previous year, turnover of the previous year, whether unit is continuing or add-on cover selected. That's all. On the basis of this information, the support office underwriting department will generate the quotes. In this policy, the compulsory excess is different. Different in the sense, here it is called as the time excess. Because the compulsory deduction is for minimum 7 days, fixed 7 days, not minimum, fixed 7 days. A follow pay policy carries excess in days. It is known as time excess. Minimum time excess is 7 days. Intention of excess is to avoid small losses and to take some share of loss in major claims beyond 7 days. Other exclusions includes any restriction imposed for to restart it, lack of sufficient capital, loss of business due to causes like cancellation of license or suspension of license, electronic data or processing equipment damaged, that is also not covered, damage resulting from deliberate erasure or loss distortion is not covered, mechanical electrical breakdown not covered. This FLOP policy also provides 4 add-on covers in addition to fire add-ons, because fire add-ons will be given along with the fire policy. These add-ons will be given with the FLOP policy. These are different. First is accidental failure of public electricity, gas, water supply. Any of these or all of these. Second, damage to customers' premises due to perils covered under the policy. Third, damage to suppliers' premises due to perils covered under fire policy. And fourth, auditor's fee. Choice is of the customer, whatever add-on cover he wants, he can select. There is separate premium for that. So the system of the FLOP policy is loss may be directly caused by or indirectly caused. If it is to the loss of stock or property or building or machinery, and due to that there is any loss and that claim is paid under the fire policy, and because of that interruption there is a loss of income or profit, that will be paid. Type of business covers, these are the 4 methods to select the policy. On turnover basis, on output basis, on differences basis, on renewal revenue basis. Because the broker may ask you, we will take the FLOP policy on turnover basis, on output basis, on difference basis, or on revenue basis. So these 4 methods are different. But as per the choice of customer we will provide, because we will provide the policy on all the 4 methods. Turnover basis means useful for organizations and trading activities or involved in manufacturing, where supply of goods on existing basis with no accumulation of stock. Means turnover has to be seen. Output, reduction in the output is used. This is where the buffer stock, the loss can be worked out. That's going to be reduced reduction in output. So there, if you want output basis, you can select. Difference basis, you can select. Or revenue basis, out of any 4. Or otherwise, if we are not selecting, we will consider according to his requirement which will be suitable. Now, the policy duration is only 1 year. Short-term policy can be given. Policy exclusions are specific. Compulsory excess is 7 days, that is called time excess. Where we will not give the policy, FLOP policy, that will depend upon the decline list of the fire insurance. Because if the fire policy is not given, FLOP policy will also be not given. Say for example, we are not giving the fire policy to the mobile shop, record shop, plastic manufacturing units, standalone warehouse, shop dealings in hazardous goods. So in these cases, because fire policy is not there, FLOP will also not. They will not give the FLOP policy also. Now, see an example how this policy will be given. Say suppose a firm bought a FLOP policy. The previous gross profit was 20 lakh, they want the coverage for 20 lakh. This is an engineering workshop. Earthquake terrorism are also already included in fire policy. Indemnity period required is 3 months. Earthquake zone rate will be as per the fire tariff. So how the premium will be calculated? Simple method, sum insured is 20 lakh only. So suppose the fire rate is 1.08 for that FLOP purpose. So FLOP rate is 1.08 per milli multiplied with the 20 lakh rupees. The premium would be only 2160 plus GST. Simple method. And if there is any claim, how the claim will be calculated? Let us see an example. Say the firm has taken the sum insured of 30 lakh rupees. Indemnity period is only 3 months. Perils covered are as per the fire policy. Cause of loss is flood. Flood loss is covered under the policy. Due to flood, the building has been damaged. Now, building is damaged, so the commercial activity is stopped for 8 weeks. 8 weeks. So this is the interruption period and indemnity period is 3 months. Now first of all you decide 3 months indemnity period is longer or 8 weeks interruption period is longer. Because lowest of the two will be paid. Lowest of the two is 8 weeks. Because in 3 months there are 12 weeks. So this is clear that the claim will be paid for the interruption period, that is 8 weeks. Now how this claim will be paid? Sum insured is 30 lakh for the 12 months. So we will work out in 12 months, say 52 weeks are there. That means per week 57,962.3 is payable. Loss is for 8 weeks. Compulsory excess is 1 week, that is 7 days. So loss payable is only for the 7 weeks. So when the loss is paid bill for 7 weeks only, and per week amount is 57,962. So 7 into this amount, the total payable is 4 lakh. Gross profit for 7 weeks would be 40 lakh 3,846. And 4 lakh 3,846 for 7 weeks. This is the method where the sum insured plus lowest of the two, indemnity period or the interruption period, will decide what is the amount payable. So the policy is simple, but two primary conditions are important that I will repeat again. First of all, the policy will be given only when the fire policy is there, and the claim will be given only when the claim is payable under the fire policy. Then only FLOP claim will be paid. These two conditions are there. If the shopkeeper policy is given, so for shopkeeper, 4 restrictions will apply. Sum insured will not exceed 25% of the fire sum insured. Indemnity period will not exceed more than 3 months. Premium will be 360 rupees per lakh plus GST, and minimum premium would be 500. These are the restrictions applicable only for the shopkeepers. For any other kind of firm, there are no restrictions. You can get the policy if the fire policy is there. Both the policies will be given simultaneously. If the package policy is given, both sections are there, customer can select easily. If the IR policy is given, both sections are already there, customer need not to select because this is a compact policy already. If you are giving a fire policy to anyone, with that also you can give the FLOP policy. FLOP became famous during the COVID period. When the lockdowns were there, everything was closed. Firms were running into the losses. Some firms were closed, even shutdowns, because there were no profit, no income. That time this policy became popular. But because the lockdown was imposed by the government, that was not covered under the policy. So no claims were paid in the FLOP policy. Claim is payable only if the fire policy is paying the claim, then only the FLOP policy will pay the claim. So if the loss is caused by any of the insured perils of the fire policy, then only the FLOP policy will pay the claim. This is FLOP. Now you can ask any questions, any doubts. Any doubts?